Hello financial investors and welcome to the channel. My name is Brent and today we're going to go ahead and cover the four main indexes, take a look at their performance for this past month, and then we're going to go ahead and jump and cover 5 dividend stocks that have grown and paid out dividends for the past 10, 25, or longer here in the market. Now, these are all very strong dividend stocks that I own, but I wanted to go ahead and cover why I own them and why I am going to be targeting these specific companies here in the downturn because I believe that they are solid, very strong financial fundamentals behind them, and they can weather what is currently going on in this market. So I wanted to kind of show and share these ones with you guys. If you guys are invested in them currently, definitely let me know in the comment section below. But with that said, if you are brand new to the channel, have not yet subscribed, I'd really appreciate if you do hit that subscribe button below. If you do enjoy this video, find it helpful, entertaining, definitely give this video a thumbs up. And if you have any comments or questions going over this video, the stock market, other dividends that you are buying in this current downturn, let me know. Or if you own the ones that I own or the ones that I'm covering, let me know as well. I've had a lot of feedback that I've really appreciated the feedback that I have got from other investors, letting me know what they're buying. I've gone through, done a little bit of research myself on their positions, and I had one investor who was buying one that I checked out, said it was very risky, and he notified me today that it did cut its dividend. So there's a lot of stocks out there cutting dividends. So this is one of the reasons I wanted to kind of make this video, present 5 dividend stocks that have been growing and paying out dividends for the past 10, 25 years that I believe can weather the storm. And that is it. Let's go ahead and cover this video. So what I want to do right now is start off by looking at stock futures, which look to be not moving right now. It's about 1 in the morning here on Tuesday, so the market's not quite open, but it does look like we're going to be opening lower on the day. Not sure how the rest of the market will kind of play out the rest of the day. On Monday, the market bounced. You can see the S&P up 6%, Nasdaq up 6.23, and the Dow Jones up 5.2%. A little bit of a disconnect there with the Dow Jones and the other main indexes. That is because the Boeing company, having fallen, continue to fall almost 10% on the day and continue to fall into the after hours there, an additional 10%. So Boeing is definitely bringing down the Dow a lot further than these other indexes. The other thing here is that there's a stimulus packet that is getting talked about. It's not quite implemented and rolled out. That is going to be affecting and potentially putting a bottom to this market. That's what a lot of investors are saying. I'm not sure how or if it will put a bottom. I think it may present a short-term blanket, but we'll kind of see here in the future. So let's go ahead and cover the four main indexes and see how they have done over this past month. So number one in first place is the Nasdaq, having lost 24.64% during this last month. Here, February, they were down 11.96 from what this is presenting, and here in March, they are down 14.39%, putting them down roughly 24.64% over this past month. The S&P 500 is in second place, going down 24.96%. Year to date, down a little over 21%. The Dow Jones is in third place, down 27.35%. You can see a little bit further loss. This is definitely because of Boeing. Boeing went from being a $350 company just a few months ago, now being worth roughly $120 per share. So it has definitely been taking a beating here during the short term. The Russell 2000 is in last place as far as performance, going down a whopping 34.26%. And a lot of those smaller mid-cap companies have not been handling what is going on, having to close their doors. Here in Oregon, the restaurants, if you do not have takeout, you're basically closed. No one can dine in your facility. You basically just have to close your doors. All the chairs are put up. So a lot of these small mid-cap companies, these small business owners, they are going through a bit of a hassle because they still have rent that's due. They still have business expenses that have to be covered, but they're no longer able to generate income. So they are definitely getting hurt here in the short term. And many of these companies within the Russell 2000 are going to be affected and continue to be affected during this downturn. Now, going into the 5 companies here that I want to discuss today, we're going to be starting off with Clorox, ticker symbol CLX. Now, quick disclaimer, these are all companies that I own within the M1 Finance Roth IRA over on my wife's account. So these are not anything that I'm just kind of picking out of the blue and deciding to kind of throw in here and kind of discuss. These are all companies that have done quite a bit of research here in the past, but I wanted to kind of cover these in a video today because I believe that all five of these, again, are able to kind of withstand what is going on. They are all providing products or services that not only investors would utilize, but also just the common consumer. So Clorox here, big one here in the short term. If we look at the 1 month performance and we look at the price and percentage wise over this past month, Clorox is up 20.05%. So very quickly shot up to some new all-time highs, and its dividend yield has changed by going down 16.7% just from 1 month ago. So that is percentage wise. So they were roughly at about $170, kind of trending sideways for quite a while. Here recently, their products have been going off the shelf. Now, if you're not familiar with Clorox, they sell a ton of cleaning products. If you go to your cleaning aisle in many of your stores, most of their products have been kind of pulled off the shelf that have been purchased. I'm not sure if it kind of displays it down here down towards the bottom, but some of their cleaning products include Lifestyle, Household, and International Clorox brands. So yeah, Clorox Bleach, Greenworks cleaning products, Freshed Up, Scoop Away, Cat Litter, water filters, Burpee's personal care products, and many others. So a lot of their cleaning products, sprays and stuff, have just been flying off the shelf just because of their need from consumers and medical experts. So kind of going back over here, looking at their performance here over this past year, how have they kind of stood during this downturn? Well, again, they're trading near all-time highs right now. So a very strong company, not one that I would currently invest in at this time, but it's definitely been a contender. This is actually one that I may shave a little bit off of just because of how fast and how high it has currently run up now at $197.88. But if I was a brand new investor looking at this company and wanted to add it to my portfolio, it may be one I would add to my watch list that could withstand these events. Now, I would definitely wait for it to kind of come down just slightly. I think it's overextended here in the short term. It's 50-day, 200-day moving average down in these 156, 163s. So it has not had any sort of effect here in this past month with what is going on out there in the market. Now, one of the main reasons that I had invested in this is because it had really good financial fundamentals. It's a very solid company, having grown and paying out dividends for the past 42 years. Now, in July, if we kind of scroll down here, I was taking a look at this earlier, that they have had 4 quarters of paying out $1.06. Here, they pay out they're going to be increasing their dividend in this next payout right around July 30th. They're going to be announcing a dividend increase, as this company generally does. They're not going to be cutting their dividend for whatever reason. This was just a solid dividend aristocrat, having grown and paid out dividends for the past 42 years, going on 43 years. Yes, their payout ratio may be climbing during this downturn, as maybe their earnings does get a bit of a tick, but really, their earnings, I don't believe, is going to be affected. You can see how fast, how quick their products are being pulled off the shelf by consumers, that this company may have some slightly higher earnings per share in these upcoming quarters, which will benefit their earnings, their payout ratio, and they're just be able to continue paying out and raising that dividend. Now, the other metrics here I wanted to kind of share with you guys is revenue, net income, and free cash flow over the past 10 years. Look at them in percentage wise. How have they moved? It's a very slow mover. So revenue about 1.5% on average per year, just nice and steady. You can see there has been a little bit of a dip, but I'm sure they'll kind of get where they just have little dips here and there, but just the upwards movement over the past 10 years is just solid to see. The net income here in the orange, 35%, and free cash flow, 37%, or roughly 3.6% on average per year. So just nice, steady movement to the upside. If we take a look at their littler numbers here, we can take a look at their earnings per share. Just nice, steady movement to the upside, $6.37. I believe this one will probably shoot maybe $6.50 in the upcoming quarters. We'll kind of see how this one kind of plays out. Price to book is pretty high at 44.5, but this is a sales-driven company, so price to book is not important for a sales-driven company. What you want to focus on is that price of sales here, and that's at a 4.3, so it is slightly over 3, but it's definitely within a good range. The other ratio here is 31 for their price to earnings. So recently, their price to earnings has shot up here. Let's go ahead and see if we can get a smaller number here. Look at the 1 month. So just not too long ago, they were right around a 25, maybe 26 PE, just because of how fast their price has risen. We can see that they are now at a 31 price earnings ratio. So unless their earnings grows by a substantial amount, their PE will be a bit high and elevated. But I think their just price is overextended here in the short term, just because of how fast and how much this one has been out in the media as far as their products getting bought up. So that is Clorox, and that is all the information that I want to cover. Let's go ahead and jump into our second one, Johnson & Johnson. How has this one done over this past month? So over this past month, let's go ahead and put percentage-wise. Has this one moved upwards or downwards? And it has moved downwards over this past month. You can see here, not as fast and as hard as the S&P 500, having moved down 9.02%. So it's definitely doing a lot better than the indexes. Their yield has increased by right around 11.38%. As far as that's not their yield, that's how much it's increased from just a month ago. Their actual yield's at 2.78%, but just a month ago they were offering right around a 2.6 or even around 2.5% starting yield. So you're definitely getting a nice, slightly higher starting yield with Johnson & Johnson, priced at $136. Now, if we look at their PE, their 200-day, 50-day moving average, they are currently priced below their 200-day and 50-day moving average. If we look at that, it's in the 1 year. You can kind of see here that they did have a bottoming out, some support right around that $128. So Johnson & Johnson does have support at that 128, and they did hit it. They rebounded, now at 136, and they are looking like they're moving back up to potentially kind of recovering from their downfall, but we don't know 100%, but this could be a good opportunity. If you're interested in looking at Johnson & Johnson, this could be a really good opportunity to look into it and decide if you want to add it to our portfolio. Now, the reasons that I've added to my portfolio is because this one's just a very nice steady mover to the upside. Here, we'll cover the revenue, free cash flow, net income. So over the past 10 years, their revenue is up. Again, big company, very slow mover, but it's consistent. 3.1% on average per year, or 31%. Also, their free cash flow, 31% or 3.1%. And their net income is up 1.3% or 13% over these past 10 years. There was a bit of a hiccup here. You can see that their net income dropped, but this is just because of the tax reform that took place, and I think that's just kind of done and over with, and we won't see this kind of blip here in the future. So nice, consistent upwards trajectory with their numbers there. If we look at their price to book, price to sales, PE, and earnings per share, and we look at this here in the 5-year mark, we can see that over the past 5 years, their earnings per share has been pretty consistent, just staying at that $5 range, not really going anywhere. They're not, their products are always being used. I know here in the household, we buy their baby products for the soap. We buy a number of other bathing items, soaps, and stuff from Johnson & Johnson, baby powders. So very consistent one that's in many households. I'm sure you guys also have products that are from them. Here, PE ratio is not too high, actually, at 24.26. If we compare them, well, it's not good comparison now to the S&P 500, but the S&P 500, I believe, was around 27, so this one has pulled back to 24. I'm not sure where the S&P 500 PE ratio sits as far as the total, but this one's at a 24.26. The price to book, not a really price to book sort of company. It's a sales driven company. So price to sales is at a 4.4. Again, compared to Clorox at a 4.1, I believe was Clorox, right? 4.1. Yeah, so Clorox was at a 4.1. Johnson & Johnson's at a 4.4. I would say that this one kind of trades slightly elevated just because of how well known that this company is. And the earnings per share, we've already kind of discussed it, just moving to the side. Not any reason for it to fall or grow substantial. It's just a nice, steady, consistent mover. So that is Johnson & Johnson. If we take a look at Johnson & Johnson here, this one has grown and paid out dividends for 57 years, making it a dividend king, having grown and paid out dividends for the past 50 years or more. This one's at 57 years, has a very low payout ratio of 42.3%. So this one is very, very unlikely of getting a dividend cut, unlike many others out there. And if we take a look here, down towards the bottom, when is their next dividend increase expected to come? It's expected to come out right around. They should announce it here in the future, maybe March or during this next payout, right around May. They should be doing an announcement. You can see here that they increased their dividend last time from 90 cents to 95. Now they've had 4 quarters of paying out 95 cents, so they may increase it to a whole dollar per share. We'll kind of see how this plays out, but we can maybe see a dollar per share each quarter getting paid out to their shareholders just by buying into this one, and that would put them an annualized payout ratio of $4. So buy it now, you get a nice increase here in the upcoming future. So that is Johnson & Johnson, ticker symbol JNJ. Next, we're going to go ahead and cover General Mills, ticker symbol GIS. Now let's go ahead and take a look at its price and dividend yield. Look at it here in the short term. How has it moved? So price-wise, it has definitely moved positive in the recent month. Here we have the 1 month. This one, in comparison to the S&P 500 and the other indexes, is moving higher, up 11.93%, while its yield has moved lower by 10.66%. So, what do a lot of investors, a lot of consumers stock up on? I bought a ton of oatmeal. I like oatmeal, plus during this downturn, oatmeal is really nice and easy to make as a quick meal. I'm currently now working from home right now, but even at work, I would go and buy a lot of oatmeal and other cereals and products that they produce. And I'm sure a lot of other consumers are going out there and stocking up on oatmeal during this downturn as well, just because of what's going on. So General Mills has been out in the media, up 11.93% here in the short term. Now, looking at this one in the 1 year, taking a look at it now, we can see that this company recently increased very quickly, right on from $50 to almost $60 now, and its dividend yield went from almost 4% at one point, now 3.28%. So that's a big, big change here. General Mills is not a position that I have in my portfolio that is a full position, one that I've loaded up on. It's actually not close to where I would like to have, but it's definitely shot up here in the short term, and could potentially be due for a pullback here. We'll kind of see how this one kind of plays out, but it's definitely a very strong contender. Now, diving into its revenue, net income, and free cash flow over these past 10 years, why was this one kind of selected and picked? Well, again, it's very consistent. Revenue up 14%, net income up 38%, and their free cash flow up 58%. So their products are just always kind of just getting bought. There's no real reason for their Quaker oatmeal, their cereals that are out there. They have a number of products out there. If we look here at their General Mills here and scroll down towards the bottom, they just do a bunch of products, packaged goods, processed packaged goods. They sell in the U.S., international, food services in 15 different countries, and sold in over 100 countries worldwide. So I'm not sure why. Oh, it's manufactured. So they have manufactured. That's manufactured in 15 countries, and then these products are sold in 100 countries worldwide. So they hold products and brands such as Cheerios, Progresso Soup, Hamburger Helper, Fruit Roll-Ups, and just a number of other products. So it's very, very broad. And this one is not a dividend aristocrat. This one has only paid out dividends for the past 15 years, but I believe it'll continue to pay during this downturn. You can see its payout ratio is below 60 at 58.19. And I think that it's still a very in the safe, I would say that it's around 80% chance that it would not cut its dividend. I think it's very unlikely. Now, if we look at when it is due to increase its dividend, this one has not increased their dividend in quite a while. It's actually kind of interesting. Anyways, I'm not showing any sort of dividend increases. I guess I'd have to go look at their website itself to see if they've increased it. But looks like they did kind of stall out their dividend here at 49 cents per share from around 2016. So it's been kind of consistent. That's interesting to kind of see. I'm not sure if they will increase it here in the future or what they will do. They haven't cut it. So, interesting. I thought maybe I recorded that somewhere and I just kind of lost track of it. But General Mills there. Let's move back over here and we kind of cover their financials. Let's go ahead and cover their price to book, price to sales, PE, and their earnings per share over the past 5 years. Move it back to normal numbers. So, Earnings per share, nice consistent upwards movement. They did have a huge movement here in 2018. Uh, I don't remember them being very popular in 2018. I think they're actually negative as far as their price. Earnings per share shot up definitely, came back down to be normal, and has just been continuing up to the upwards. PE ratio in the red, 17.24, below the S&P and some of the other companies that we've tracked here recently. Their price to book, not too important, at a 4.7, and that price to sales is the one here that we kind of want to focus on. So this one is below 3. I would say that's fair at 2.1. So overall, I think their financials look pretty straight. PE 17.24 doesn't seem too high, and their price of sales is at a 2.1, which does not seem too high either. I think it looks like a fair value. It is spiked up here in the short term as far as their price, but I'm not sure if it'll fall or not. I think that they're doing really well for their business. I think it was kind of beat up here in the short term, and they just kind of maybe just kind of blossoming. Who knows? Now taking a look here at stock number 4, we have Walmart, ticker symbol WMT. Now here over this past month, let's go ahead and look at it percentage wise. Where has it been? Basically flat. Price is up 1.16%. Yield is down 1.15%. So basically kind of flat throughout this market. Yes, they kind of hit some, they did fall initially down almost 10%, but they picked it right back up. I know I've read about Walmart quite a bit on the media, how they're doing testing centers in their Walmart parking lots, how they're now kind of working with the indices, the businesses out there and such to kind of help for the testing and such. So I think they're doing a lot of beneficial work, and definitely a very strong contender. Now let's go ahead and look with their 200-day, 50-day moving average. Look at their 1-year performance here. Take away their percentages here, and there we are. So over the past year, they've definitely been trending upwards. Currently trading not all-time highs, but just in that middle area. They're not too far above their 200-day, 50-day at 119, while the other ones are at 115. They do have a slightly lower yield than they have in the past. If you had just bought them a year ago, you would have locked in nearly a 2% to almost 2.4% starting yield, whereas now you're basically getting a 1.78% starting yield. So now could be a pretty high time to buy. It hasn't really shot up, it hasn't really shot down, or been affected here during this downtrend. One of the reasons that I added it to my portfolio is because they have very strong financial fundamentals behind this company. Again, if we look at the revenue, net income, and free cash flow, just very nice and consistent revenue, up 2.6% per year or 26% over the past 10 years. Net income in the orange, 1.4%. Their net income does fluctuate quite a bit here, basically flat. It's a grocery outlet, sort of like a value grocery outlet, so I'm not sure what they could kind of do to kind of increase their bottom line there for their net income, but it's being consistent, and their free cash flow is at 26.4%, and it has been decreasing here slightly, but not too important of a number, just knowing that it is positive here. Jumping into their other metrics here, price to book, price to sales, and their earnings per share over the past 5 years. Let's go ahead and do this, not percentage, original numbers here. So they did have a bit of a issue here with their earnings per share dropping down. Doesn't look like it really affected their price there, so I'm going to go ahead and remove that. But they did have a portion here during, I'd say, 2015 to about midpoint 2018, where their earnings per share was decreasing quarter after quarter, year after year, up until about mid-2018, then has started the rebound. So this could be one of the reasons that their price just has been kind of stagnant from 2018, just kind of trending sideways. But this could be an opportunity where Walmart will trend higher here in the future. So right now, it may look like Walmart is trading near all-time highs, but it may have more potential in it in the upcoming future. Now, taking away their price here, their price to earnings is a 22.98. So this was not as high as the Clorox and Johnson & Johnson, and it's slightly higher than General Mills. The price to book is at a 4.5, and a price to sales is at a 0.65, putting it below. So very nice statistic there at 0.6. You don't see that in a lot of sales-driven companies. So Walmart here with a ratio under 1 means that they're basically getting their stock price is trading below their sales number. I'm not sure what their worth the ratio is for the sales, but generally you don't see a number under 1 in this style of a company. Now, I think that's all the information there. Jumping over here into the how long this one has grown and paid out dividends. This one's grown and paid out dividends for the past 45 years. So almost a dividend king at 50 years. Very low payout ratio. Again, almost 100% chance that this company will not cut dividends. It doesn't have any reason to. It's not in any sort of risk. It's going to continue to earn earnings. I see a lot of investors going into Walmart. I shop at Walmart. I shop at I live, not live, I work right across from Walmart. So every day I can look out my window, I can see Walmart, I can see all the craziness that they have going on, all the shoppers there that are going in there with their carts. And here in Oregon, everybody has to drive, they have to bring their own bags. So you can see everybody rolling in to the store with all their carts and bags in their baskets, and their shelves have been empty lately. So I think earnings for Walmart will do really well here in the upcoming future. Now this one has actually increased their dividend year after year, quarter after quarter. After 4 quarters, they usually raise their dividend. This one hasn't been raising it by too much. You can see here, they went from 51 cents to 52 cents, 50 cents. They went from 49 to 50 to 51 to 52. Here, they're now at 53, 54. And this is their 4th quarter here, 54, 54, 54. They have 4 quarters of paying out 54 cents. So they should be announcing a dividend increase in the future. Oh, okay, so that's not going to be quite a while. That's going to be in January of 2021. So they've already displayed what they're going to be paying for 2020. So it looks like they actually increase it at the beginning of every year. They just sort of broadcast what they've raised it to. So you're more than likely not going to be getting another raise. Looks like they just did increase it here in January, February. They're going ex-dividend this month on the 19th, which is tomorrow on Thursday. So you can actually buy this one today as you're watching this video and get the ex-dividend here for Thursday. Interesting, nice. And that is Walmart. So last but not least, we have AT&T, ticker symbol T. Now, how has this one performed over this past month? Let's go ahead and check this one out. This one has came off their highs. This one was, I think, priced around $37, $39. It did come down around 10%, down 11.79%. So this one actually has had a bit of a price change. This one recently was purchased. I bought this one on Monday in my portfolio. And so it hasn't performed as bad as the other indexes, and it is looking like it's maybe finding a bottom there here in the short term. Let's look at it here in the 1 year with a 250-day moving average, back at normal numbers. So again, I recently bought it around $31, I believe, 31, 32. It's now at 33.74. Putting it below its 200-day, 50-day moving average. It does have a nice starting yield of 6.08, not as high as the 6.5% starting yields that it had just about 1 year ago, but it still does have a bit of an oomph behind it, so it may trend back up into these $37, $40 mark, just because of the Time Warner and some of their DirecTV that they have. If a lot of their consumers are staying home and using their products, a lot of more ads are going to be displayed on their devices, and that'll kind of raise it up in the background. Now, taking a look at their revenue, net income, free cash flow over the past 10 years, percentage-wise, I always like to kind of look at their trend lines. Revenue up 47%, or 4.7% on average per year. Net income in the orange, 21%, or 2.1% on average per year. And free cash flow, 69%, or 6.9% on average per year. So very strong, moving to the upside numbers. And looking at their other metrics here, over the past 5 years, we'll look at the numbers here. Earnings per share has been kind of slacking, so 2018 was a good year for them, but they have been trending down lower here at 190. So I'm not sure how this will actually kind of play out in the future with what's kind of going on, if this will really affect their earnings. Investors, consumers have to have cell phones. I actually do not use AT&T as my own cell phone. I use Verizon on mine, my carrier. But I know that a lot of people are not just going to go out there and get a new, they're not going to get rid of their phone service just because of what's going on. Everybody needs a phone, everybody needs a service provider. The two main ones out there that a lot of consumers use are AT&T and Verizon. So I don't see their earnings per share dropping by so much. We'll kind of see how it kind of picks up in the future. But PE and price of sales is both about 1.3, both below 3, and their price of sales and price to book is at 1.3. PE is actually at 17.76, so not as high as it has been here in the short term, but definitely not as low as it has been just about a year ago. So kind of interesting. And this is due to their earnings falling by so much. So as their earnings has fell, but their price has gone up. So if we bring our price in here, their price has moved higher, but their earnings has moved lower, causing their PE ratio to shoot from around 14. I think it was around 14 or so to now 17.76. So you're getting a higher valuation there for a business that's lowering earnings, but their price is still moving upward. So we'll kind of see how this one kind of plays out in the future. I think it's still a good deal. I look at AT&T as a sort of consistent bond. It pays a very nice yield of 6%. The price doesn't swing too heavy. You may get anywhere from lows of $27 to as highs as almost $40. So it did actually break $40 not too long ago, but I don't usually see it staying. I look at it, I look at it as utility. It's very consistent. Everyone needs a service provider, and I think it just kind of stays within that range. It doesn't have any reason to break out crazy, and like a Netflix or a Disney, and even Disney has been hit very hard here in the short term. So those are the 5 companies. AT&T here growing and paid out dividends for the past 35 years. Payout ratio below 60. Dividend yield right around that 6.64. And this one does raise and grow payout. Does raise and just recently raised their dividend from 51 cents to now 52 cents starting back in January. So they're going to be paying 3 more quarters at 52 cents, and then it looks like they'll probably raise it to 53 cents. So it's a very steady, very slow grower as far as its dividend yield, but you are getting a very nice starting yield of around 6.64%. So nice over 6%. So those are the 5 companies that I kind of want to be focusing on. Not all of these are negative in the portfolio. I think of all of these 5 positions, only Johnson & Johnson and AT&T are currently negative in the portfolio. And after today, I really haven't looked at my portfolio on Monday, so I'm not sure how they really did or where they're currently at. I know I purchased AT&T yesterday, but I'm not, they kind of rebounded here a little bit today. I would really like to see Johnson & Johnson continue to move a little bit lower. I would like to see Walmart also move a little bit lower. I would like to see all these positions kind of move a little bit lower. I may be taking a little bit of profits out of Clorox. I'll have to see where the equity's kind of sitting in that one. But I think these are all very strong contenders to kind of weather through just about any storm out there, because these are all products and services that consumers need. So let me know in the comment section below, do you agree with these 5 stocks? I see a lot of other investors throwing out some positions as well, and I want to kind of give some feedback and provide some information. So that is going to be it for today's video. Not too long of a video, 30 minutes. I think that's actually pretty long. But that is going to be it for today's video. If you guys did enjoy this video, definitely give me a thumbs up. If you have not yet subscribed to the channel. And if you have any comments or questions going over this video, any other video out on the channel, or want to let me know what stocks you are buying or planning on buying, drop them below. I do read and reply to all your comments. And that is it. Thank you all for tuning in. I will see you next time. Have a great day. Bye.